Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for joining us. Maybe you're on one of the 42 radio stations around the country. Maybe you're watching us on YouTube. Maybe you're listening to us in your car on iTunes or the show website, commercialrealestateshow.com. Thanks for being with us. Well, we have a great show for you today. We're going to talk about the industrial real estate market. The industrial market has been very exciting. Investors have shown a lot of interest in the space. Users are having some challenges finding space. We're seeing rates increase. It's a great market. So let's see where we are in the marketplace, and let's see where we're headed and what are some of the trends in the industrial space and in that sector, and what are some things that could impact it moving forward. Please welcome my first guest. It's Ryan Severino. Ryan is a senior economist with REIS. Ryan, thanks for joining us today.
Hello, Michael. Thanks for having me back on. Always a pleasure to talk to you.
Well, we appreciate you calling in from New York. The weather there good today?
Yeah, it's actually pretty nice. I'll take 70s in November anytime I can get it, although I know that is that's an ephemeral thing. I know it won't persist, so I'm trying to enjoy it as best I can while it lasts.
Well, that's fantastic. Next week, I'm going to San Diego, and I'm going to be speaking there at the National Association of Realtors, and I'm going to speak to the group on the top 10 success strategies for commercial agents, so it should be nice in San Diego.
I bet.
That'll be fun. Well, let's talk about the industrial sector, Ryan. How has it performed year to date so far? What do you see?
I'd say year to date, the performance in the sector has been solid. Overall, we're still seeing vacancy rates decline, rents are going up, and even though construction is increasing as well, we still see demand outpacing new supply growth. So all of the major indicators are really trending in the right direction, and there's really a lot of strength across the industrial market these days, and that is really being supported by a little bit of inconsistent growth in the economy, but still growth in the economy, better performance out of the U.S. Consumer, and I think all of the underlying fundamentals are translating into really solid performance in the industrial market these days.
Well, that's good news and maybe a good sign for the economy. So are the rental rate increases and occupancy increases you see today, I mean, how does that compare to, say, recent years or prior recession? Where are we?
It obviously differs by which subtype we're talking about, but I'd say both of the major subtypes are performing well. So for warehouse distribution, vacancy is down to about 10.7% in the third quarter, which is a post-recession low. Rent growth has slowed a little bit versus last year. We had a little bit of an acceleration in rent growth last year, but we're still growing, at a kind of a healthy 1.5–2% pace, so well in excess of inflation. For Flex R&D, vacancy was really continues to improve, down to about 12% during the third quarter. Similarly, we've seen a slight slowing in rent growth there, kind of down at that 1.5% range or so, but this really looks to be a transitory disruption and not anything permanent. I think, there's been some fallout from, what's gone on in the global economy and how that's impacted global supply chains and the like, but overall, we still see strength across the board in industrial, so lots to like these days.
And this 10.7% vacancy, how does that compare to, say, pre-recession days that maybe people would have considered normal?
We're getting quickly back to normal. We're not quite as low as we were before the recession. I think before the recession, the market was pretty hot. We were looking at single-digit vacancy rates, but we are going to get back to that relatively soon. So I think if we're not in what most market participants would consider to be a strong market environment, we are definitely in a healthy environment, heading for a strong environment in the near future.
Okay, and you mentioned Flex has a little more vacancy. What are the variances in the various property types inside of industrial today?
Flex is the one that's kind of a little bit weaker than what we're seeing in warehouse distribution, but that tends to be the norm. It's kind of that quirky space, and some of the users are a little bit off the wall. But I think the overarching theme really is that the across the board, we're seeing improvement. Even in manufacturing, which is not a huge part of the industrial market, even there we've seen, a little bit of onshoring activity returning. And I'd say, you do get a variation in performance based on the subtype, but overall, the high tide is really raising all of the ships at this point. So I think more than the variation across sectors, I think the story is just that so many corners of the market are performing so well these days.
I like that analogy, ships, since we're talking about industrial. That works, doesn't it? And speaking of ships and ports, are there certain areas that are really hot?
There are, and I think some are located at the ports. Los Angeles is performing well these days, as it really has a tendency to do. Miami, South Florida is performing well, but we've also seen performance from what I would consider to be other important distribution. I'll call them markets. Some of them are a little broader than just an individual metro per se. But if you look at Atlanta, there's been strength there. There's been strength in Houston. There's been strength in the kind of eastern Pennsylvania / Central Jersey market. Those are some of the stalwart distribution markets across the country. But then if you look at some of the smaller markets, they're also poised to perform well, especially the ones that are really keyed into distribution. Places like Memphis and Kansas City and Nashville are also doing well. So this is a pretty pervasive recovery. And you always have this sort of have and have not distribution markets, but I think going back to the tide analogy, it's not just subtypes, it's also across markets. We are seeing the high tide raising just about all of the ships at this juncture.
And is it also the tide rising for all sizes of properties? Because I think some of our listeners may think of industrial as these huge buildings that like Amazon uses, and some people may think of the little industrial buildings they see in their neighborhood.
For most of this recovery, I think that was the story. That was true. You really did have the larger properties leading the charge, especially the ones that cater to e-commerce tenants like Amazon. But that has started to change over the last 12 to 18 months. Now we're seeing even smaller properties are participating in this rally, especially as the market tries to solve that, the last mile problem. How do you get goods into the hands of those inner city consumers in a timely manner, especially, with e-commerce and all? I think there are opportunities in smaller buildings that are well positioned, and this wasn't the case, if we went back maybe 24 months ago. But that dynamic is starting to change as people realize that there are opportunities to get goods to consumers in places where it's hard to find good infill locations. Certainly in places where you're not going to be able to shoehorn in a 1.2 million square foot distribution monster or something like that.
Right, and that's good news. We're talking with Ryan Severino with REIS about the industrial market. So Ryan, what do you think moving forward? Do you think this great activity is going to continue with this great performance?
I do. I think for warehouse distribution, I'd expect to see vacancy to continue to fall. We forecast out from where we are today, it's closer to a 4-year forecast than 5, but over the next 4 years or so, probably another 150 basis points, give or take, on the vacancy side. I'd probably expect rents to grow over that interval at a kind of 2 to 3% per annum pace, getting stronger as vacancy falls over that forecast horizon. I'd say for flex R&D, I'd expect to see vacancy fall another 200 basis points or so over the next 4 years, with rents also kind of growing maybe a little bit faster than on the warehouse distribution side, more in the 2 to 3.5% range, but same kind of dynamic. The more you go into the future, the tighter vacancy gets. Obviously, it's a little easier for landlords to push rent increases onto their tenants, so getting stronger toward the end of the forecast period than we see toward the beginning of the forecast period.
Well, that's good news for owners of industrial properties for sure. That sounds great. Well, how are new deliveries impacting it? You mentioned earlier that there is some new supply being built. So where are we on new supply? Is that part of the picture that's helping this performance?
Yeah, it's interesting because construction is definitely on an upswing, as I think you could imagine, given the strength in the fundamentals that we've been seeing lately. For warehouse distribution, which is really the majority of construction activity that we're seeing these days, we're looking at about, 70 million square feet or so coming online this year, which is a post-recession high, and that's a fairly normal, healthy level. I would think it would abate a little bit over the next few years, but remain at elevated levels, which, is indicative of a strong market. I think the one thing about industrial that tends to not put people off, but concern them a little bit, is that obviously barriers to entry are relatively low in this space. So construction can ramp up quickly when the market senses that fundamentals are really improving like they are today. But that said, I think there's so much demand out there that even with construction increasing, we expect to see vacancy rates continuing to decline over the next 4 to 5 years. So I would not be, I wouldn't lose too much sleep over construction, at least on a macro basis.
Yeah, well, that's a good news, and it explains your forecast for continued improvement in the space. Well, I want to ask you about the investment property, what you see there for cap rates, but we'll take a short break. We'll be right back with Ryan Severino with REIS. I'm Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll be right back.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit creshow.com.